Wait till Trump sits across from Netanyahu discussing Iran nuclear talks, while the jobs report shows 2025 had almost zero employment growth. Silver ETFs just experienced the most violent liquidation event in modern history. Leveraged ETFs mechanically unwound. Billions in silver sold in days. And the question everyone's asking is simple. Is this the buying opportunity of the decade, or the signal that everything's about to unravel? February 12th, 2026, silver just hit 85.65 per ounce. But here's what nobody's talking about. I'm not a financial advisor. This isn't financial advice. This is purely educational analysis based on publicly available information from February 2026. But what I'm about to show you is a convergence pattern that appears once, maybe twice, in a generation. Three massive forces colliding simultaneously. Geopolitical tension with Iran escalating, jobs data revealing cracks nobody saw coming. And silver experiencing 162% gains, followed by historic volatility that wiped out half its value in 48 hours. The choice you make in the next 30 days could define your portfolio for the next decade. Let me show you what the data is actually saying. The Iran situation. Right now, February 12th, Trump just finished nearly 3 hours with Netanyahu. And here's what matters for markets. No definitive agreement was reached. Trump stated he insisted negotiations with Iran continue. But the tension is real. Netanyahu wants talks expanded beyond nuclear issues to include Iran's ballistic missile program and regional proxy support. Iran has publicly stated missiles are non-negotiable. And Trump? He's positioned 2 aircraft carrier strike groups in the Persian Gulf. The USS Abraham Lincoln is already there. A second is reportedly preparing for deployment. Trump told reporters directly he's thinking about sending another carrier, and if talks fail, bad things will happen. Why does this matter for silver? Because when Trump struck Iran's nuclear facilities in June 2025, silver was trading around $32 per ounce. Within months, it climbed above $100. That's over 200% in less than 8 months. But the rally wasn't driven by the strike itself. It was driven by what happened after. Supply chain concerns, industrial demand uncertainty, and most importantly, safe haven rotation out of dollar-denominated assets. Right now, we're in round 2 of talks. First round happened February 6th in Oman. Indirect talks between Trump's envoy Steve Witkoff and Iranian Foreign Minister Abbas Araghchi. Both sides agreed to continue discussions. But the gap is massive. Iran wants nuclear discussions only. The US wants comprehensive limits on nuclear program, missiles, and regional activities. Here's my analysis. If talks collapse and Trump follows through with military action, we could see another supply disruption event. Not because Iran produces silver, but because Middle East instability triggers industrial demand concerns for electronics, solar panels, EVs. All use silver. When uncertainty rises, investors rotate into hard assets. But if talks succeed, that's the more interesting scenario. A deal removes geopolitical premium from silver pricing, which means silver would need to stand on fundamental supply-demand dynamics alone. No geopolitical cushion. Second round of talks expected this week, possibly in Turkey. The market is watching 3 indicators: carrier deployment status, protest activity in Iran, any executive actions from Trump on sanctions or military positioning. These will signal whether we're heading toward resolution or escalation. The jobs data bombshell. February 11th. The delayed January jobs report dropped. Headlines looked fine. 130,000 jobs added. Unemployment ticked down to 4.3%, better than the 75,000 expected. But here's what they're not telling you, the revisions. 2025 job growth was revised down from 584,000 to just 181,000. That's a downward revision of 403,000 jobs for the entire year. The US economy barely added jobs in 2025. And it gets worse. The annual benchmark revision showed 898,000 fewer jobs were added between April 2024 and March 2025 than initially reported. The downward revision was 862,000 on a non-seasonally adjusted basis. That's the second largest negative adjustment on record. The only larger revision was 902,000 in 2009 during the financial crisis. Manufacturing showed little change in January. Factory jobs rose 5,000, the first increase since January 2024. But that's 1 month. Federal government employment lost jobs. Financial activities lost jobs. Healthcare added 137,000 jobs. That's 105% of total job gains. Without healthcare, we'd have had net job losses. Here's where this connects to silver. When employment growth stalls, when revisions show the economy was weaker than believed, the Federal Reserve's calculus changes. Markets are pricing in roughly 60 basis points of easing by year end. That's 2 quarter-point cuts. Weaker employment data supports that dovish stance. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver. When rates fall, precious metals become relatively more attractive. Federal Reserve Governor Christopher Waller said employers are reluctant to fire workers, but also very reluctant to hire. That indicates considerable doubt about future employment growth and suggests substantial deterioration in the labor market is a significant risk. Translation: the Fed sees potential weakness ahead. They're preparing for a scenario where job growth doesn't just slow, it potentially reverses. And in that environment, precious metals historically outperform. Here's the pattern. Jobs data deteriorates. Fed turns dovish, dollar weakens. Commodities, especially precious metals, rally. We saw this 2008 to 2011. We saw it 2019 to 2020. We might be seeing the early stages right now. Silver's historic volatility. January 29th, 2026. Silver hit an all-time high above $100 per ounce. Historic. Record-breaking. Then, January 30th happened. The metal crashed nearly 50% in days, from over $100 to below $50, the largest percentage drop in modern silver trading history. What caused it? Leveraged ETF unwinding. Specifically, the 2X Pro Shares Ultra Silver ETF, ticker AGQ. According to Bloomberg data, this ETF sold billions of dollars worth of silver mechanically, not based on fundamentals, based on rebalancing requirements. Here's how leveraged ETFs work. They use derivatives and leverage to amplify returns. 2x means if silver goes up 1%, the ETF targets 2%. But that leverage requires daily rebalancing. When volatility spikes, these funds must sell to maintain their leverage ratio. And in late January, volatility exploded. U.S. Treasury Secretary Scott Bessent attributed the extreme swings to Chinese traders. He described the rally as a speculative blow-off. Whether that's accurate or political positioning, the effect was real. Historic liquidation. But here's what happened next. Silver stabilized around $77 to $85 per ounce in early February. That's B where we are now, down from the 100-plus peak, but still up 162% from a year ago, still at levels not seen in over a decade. The Silver Institute released a report February 10th stating global silver investment will remain strong in 2026, against a backdrop of a sixth consecutive annual market deficit. Physical supply deficit, not paper. Physical. Demand for actual silver exceeds mine production and recycling. Industrial applications are driving this. Solar panels need silver paste for conductivity. Electric vehicles use 3 times more silver than traditional cars. 5G infrastructure, AI data centers, medical devices, all require silver. And that demand isn't speculative, it's structural. Fundamentals temporarily. The question is whether current levels, $80 to $85, represent fair value based on supply-demand dynamics, or whether we're still unwinding speculative excess. Strategy considerations. Educational only? Let me be crystal clear. I cannot tell you to buy or sell anything. What I can do is walk through different approaches investors are considering. Educational observation, not recommendation. JP Morgan Global Research projects silver averaging $81 per ounce in 2026, more than double the 2025 average. Their analysis cites industrial demand and supply deficits as primary drivers, not just investment demand. When leveraged products unwind, they create dislocations. Prices disconnect from approach 1, dollar cost averaging into physical-backed ETFs. Some investors are looking at funds like SLV, iShares Silver Trust. These hold actual silver bullion. The thesis: if you believe in long-term supply deficits and industrial demand growth, short-term volatility creates entry points. Instead of timing the market, you average in over weeks or months. The consideration? Storage costs. Physical-backed ETFs charge expense ratios, typically 0.50% annually. Over decades, that compounds. Also, if leveraged ETFs continue unwinding, more downside could occur. Approach 2. Wait for technical confirmation of bottom. Some traders are watching specific price levels, $75 per ounce as potential support. The 200-day moving average. Volume patterns. Wait until price action confirms liquidation is complete. The consideration: you might miss the bottom. If silver rebounds quickly, waiting for confirmation means entering at higher prices. Opportunity cost. Approach 3. Avoid leveraged ETFs entirely. After witnessing AGQ's forced selling, many investors are reconsidering 2X and 3X products. Yes, they amplify gains, but they also amplify losses and create forced selling during volatility. The consideration: lower potential returns. If silver rallies 50%, a 2X ETF theoretically returns 100%. But the downside risk can be catastrophic. Approach 4. Mining stocks as leveraged exposure. Some investors prefer silver mining companies. The logic is operational leverage. When silver prices rise, mining profit margins expand faster than the metal price itself. The consideration? Company-specific risk, management quality, Geopolitical risk if mines are in unstable regions. Operational issues. Mining stocks add variables beyond silver price. Approach 5, combination allocation. Maybe 70% physical-backed ETF for core exposure. 20% miners for operational leverage. 10% in cash to deploy if prices drop further. This diversifies across different silver exposure types. The consideration, complexity, more moving parts, more decisions, more opportunities to make mistakes. The convergence. Here's where this gets interesting. We have 3 major forces converging. Geopolitical tension, with Iran potentially escalating or resolving. Jobs data showing economic weakness that could drive Fed easing. And silver experiencing historic volatility that might be creating dislocations. What happens if all 3 align bearish? Talks collapse. Trump launches strikes, oil prices spike, economic data deteriorates further, jobs losses accelerate, the Fed cuts rates aggressively. In that scenario, safe haven demand for silver could overwhelm industrial demand concerns. We might see another run toward $100 or higher as investors flee uncertainty. What happens if all 3 align bullish? Talks succeed. Iran deal reached. Geopolitical premium evaporates. But simultaneously, economic weakness forces Fed cuts. Lower rates support precious metals. Industrial demand continues strong due to EV and solar growth. Silver might not hit $100, but it could establish a sustained floor around $70 to $80 with gradual uptrend. What happens if they misalign? Maybe talks succeed, removing geopolitical premium. But jobs data strengthens, removing Fed easing expectations. Industrial demand slows due to economic softness. Silver could test lower levels, potentially $60 to $70, as both safe haven and industrial demand weaken. Nobody knows which scenario unfolds. That's why the purely educational observation here is about risk management, not prediction. Pattern recognition. Let me walk through what historical patterns show. Not guarantees, patterns. Pattern 1, when silver experiences 100% plus rallies followed by 40% plus corrections, it typically consolidates for 3 to 6 months before the next major move. We saw this 2010 to 2011. Silver rallied from $17 to $49, crashed to $26, consolidated, then made another run. We saw it in 2020. Silver rallied from $12 to $20, pulled back to $22, consolidated, then trended higher. Right now, we've had the rally, we've had the crash. The question is whether we're in consolidation or heading lower. Pattern 2. When geopolitical tensions in the Middle East escalate, precious metals initially rally on fear. Then, they either sustain those gains if the situation worsens, or give back gains if resolution occurs. In 2020, when US-Iran tensions spiked after the Soleimani strike, gold rallied. When tensions de-escalated, gains partially reversed but didn't fully collapse. Right now, we're in escalation phase. 2 carrier groups, ongoing talks, uncertain outcome. The pattern suggests silver holds elevated levels until clarity emerges. Pattern 3. When jobs data revisions are this large and negative, they historically precede Fed policy shifts. The 2009 revision preceded Fed easing. The 2001 revision preceded cuts. Large negative revisions signal the economy was weaker than believed. That typically leads to easier monetary policy within 3 to 6 months. If that pattern holds, Fed cuts could come Q2 or Q3 2026. Lower rates reduce opportunity cost of holding silver. Historically, silver performs well during Fed easing cycles if there's no recession. Risk factors. Let me highlight risks that aren't making headlines. First, Chinese demand. China is the largest silver consumer for industrial applications. If China's economy slows more than expected, industrial demand could weaken significantly. Second, derivative unwinding isn't finished. The leveraged ETF liquidation in late January was one event. If volatility remains elevated, other leveraged products might face similar pressure. More forced selling could occur. Third, dollar strength. If economic data surprises to the upside, if the Fed holds rates steady longer than expected, the dollar could strengthen. Strong dollar typically pressures commodities including silver. Fourth, regulatory changes. If regulators step in to limit leveraged ETF products or change margin requirements for silver futures, that could reduce speculative demand. Less speculation can mean less volatility, but also less upside momentum. Fifth, supply response. If silver prices remain elevated at 80 plus, mine production could increase. Higher prices make previously uneconomical deposits viable. Increased supply would pressure prices over time. Timeframes and decision points. If you're considering silver exposure, educational observation only, here are the decision points to monitor. Near term, next 2 to 4 weeks. Watch the second round of Iran talks. If they collapse and Trump escalates militarily, expect safe haven bid. If they progress positively, expect geopolitical premium to fade. Binary event with clear market implications. Midterm, next 2 to 3 months. Watch March and April jobs reports. If the weak trend from January continues, if revisions remain large and negative, Fed cuts become more likely. Watch Fed statements carefully. Any shift toward dovish language supports precious metals. Also, watch silver volatility indexes. The CBOE Silver ETF Volatility Index shows market expectations of future price swings. When volatility contracts after spikes, it often signals calmer markets ahead. Long term, 6 to 12 months. Watch industrial demand data, solar panel installation rates, EV production numbers. These are fundamental drivers. If industrial demand remains strong despite economic softness, that supports the structural deficit thesis. Also, watch the gold-silver ratio. This measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, the ratio averages 60 to 70, currently around 59 with gold at $5.54 and silver at 85.65. When the ratio is low, silver is relatively expensive versus gold. When it's high, silver is cheap. The educated decision framework. Let me walk you through how to think about this, purely educationally, not what to do, how to think. Question 1. What's your time horizon? If you're thinking 5 to 10 years, short-term volatility matters less. If structural deficits exist, if industrial demand grows as projected, silver exposure could make sense regardless of near-term price swings. If you're thinking 6 to 12 months, you're trading volatility and need precise entry and exit. Question 2. What's your conviction on fundamentals? Do you believe industrial demand growth is real and sustainable? Do you believe mine production can't keep pace? Do you believe inflation will remain elevated, making hard assets attractive? If yes to these, volatility might be opportunity. If no, volatility might be risk to avoid. Question 3. How much volatility can you tolerate? Silver just experienced a near 50% crash in days. Can you handle that without panicking? Can you hold through drawdowns if your thesis remains intact? If not, silver might not be appropriate regardless of fundamentals. Question 4. What's your allocation framework? Are you considering silver as 2% of portfolio, 5%, 10%? The amount of risk you can take depends on position size. A 2% position crashing 50% is a 1% portfolio loss. Painful but not devastating. A 10% position crashing 50% is a 5% portfolio loss. That's significant. Question 5. Are you using silver as insurance or speculation? Insurance means you expect it might lose value, but you hold it anyway because it protects against specific scenarios. Speculation means you expect it to gain value and you're trying to profit. These require different mindsets and different position sizing. Right now, February 12th, 2026, silver is at 85.65. Up from $80 a few days ago, down from 100 plus 3 weeks ago, up 162% from a year ago. What does that price tell us? It tells us the market is uncertain. If silver was definitively overvalued, we'd be back at $60 or lower. If it was definitively undervalued, we'd be retesting $100. At 85 SPA dollars, the market is saying, we're not sure. The convergence of factors creates ambiguity. Iran talks could go either way. Jobs data could strengthen or weaken. Industrial demand could hold or soften. Nobody knows. And that ambiguity is actually information. It tells you that if you have strong conviction one way or the other, you might have an edge. But it also tells you that if you don't have strong conviction, forcing a decision might be premature. Here's what we know for certain. The next 4 to 8 weeks will provide clarity. Second round of Iran talks happen this week or next. February jobs report releases March 7th. March jobs report releases April 4th. Fed meeting is March 18th to 19th. Within 60 days, we'll have significantly more information about geopolitical trajectory, economic strength, and Fed positioning. Those 3 inputs drive silver pricing in the current environment. If you're considering exposure, the purely observational question is whether you want to position before that clarity or after. Before means potential better prices, but higher uncertainty. After means less uncertainty, but potentially higher prices. If the news is supportive, there's no right answer. Only different risk-reward profiles. What I can tell you is this. February 2026 is unusual. It's unusual to have 160% plus gains in a commodity. It's unusual to have 40% plus crashes immediately after. It's unusual to have geopolitical tensions at this level, while jobs data revisions are this negative, while leveraged ETFs are unwinding. Unusual doesn't mean opportunity. Unusual doesn't mean danger. Unusual just means the pattern we're seeing doesn't have many historical comparisons, which means extrapolating from past behavior is harder. Closing. Silver hit 85.65 today. Trump and Netanyahu couldn't agree on how to handle Iran. The jobs report revealed 2025 had almost no employment growth. Leveraged silver ETFs just experienced historic liquidation. Three forces, one metal, massive uncertainty. I showed you the geopolitical patterns. I showed you the economic data. I showed you the technical volatility. I walked through different approaches investors are considering. I highlighted the risks nobody's discussing, but I can't tell you what to do. This isn't financial advice. This is education. This is observation. This is pattern recognition. What happens next depends on factors nobody controls. Will talk succeed or fail? Will jobs data strengthen or collapse? Will silver volatility calm or intensify? The only certainty is this: the decisions you make or don't make in the next 30 to 60 days will be made with incomplete information, just like every investment decision ever made. The question isn't whether you have perfect information. The question is whether you have enough information to act according to your own analysis, your own risk tolerance, your own time horizon. February 2026. The convergence is happening. The data is here. The choice is yours. If this analysis changed how you see the current market environment, if you understand now that geopolitics, economics, and technical factors are converging in unusual ways, then you have a framework for thinking through your own decisions. Not my decisions, yours. Because in the end, it's your capital, your risk, your timeline, and your responsibility. The Iran talks continue. The jobs data will update, silver will move, and you'll decide what, if anything, that means for your portfolio. Not financial advice. Do your own research. Consult professionals. Make informed decisions. The February 2026 convergence is here. What you do with this information will determine whether you're positioned correctly or learning the hard way.